Hi, good afternoon. Len Pro here. I wanted to make a quick video and talk a little bit about the US Treasury 10-year note. Now, this is a really easy way that you can track what mortgage interest rates are doing. So on my screen, this is a graph of the 10-year Treasury note yield going back to mid-July. And so you can see on the left side of the chart, since July, leading up to the Fed rate drop on September 18th, the yields were dropping, which means mortgage rates were dropping. So going trend line from here to here. Now, once the Fed lowered the Fed funds rate, contrary to what you might think, those gains are already priced in. And so it's typical to have a bounce in the 10-year Treasury note after the Fed lowers the Fed funds rate. So in this blue graph here on the left, you can see going back 40 years, every rate cut drop was followed by a spike, with the exception of 2019. So there's a spike in the 10-year Treasury note, and then it comes back down. So typically, it declines about 40% during the cycle period. So our hope is that the 10-year Treasury note yield will come back down along with mortgage rates over the next few weeks or months. Now, tomorrow, on Thursday, we're getting the CPI numbers and the core inflation numbers, and this is a month-over-month number. So depending on the outcome of that report, mortgage rates could change up or down. Now, we do think they're going to come back down because we're expecting favorable CPI numbers. Shelter costs should be trending downward, which is a big part of CPI. So we'll wait and see what tomorrow's report says, but you can see that since the Fed hiked or lowered the rates, 10-year Treasury note has been coming up. So keep an eye out for more updates. Let me know if this was helpful. And if you have any questions about mortgage rates, I'm happy to help. Talk to you later. Bye-bye.